Hi, this is Todd Baker, your certified mortgage planner, and I'm here with Jake Baxter of ARC Mortgage. Jake is our investor that we work with for non-qualified mortgages, which are mortgages simply that don't fit in the box of the government or the conventional loans. And the topic of this video is going to be what's called debt service coverage. And Jake's going to go into a little bit of overview for you so you understand it. And this target audience really of this, it could be any consumer, but we're going to be sending it out specifically to my realtors and builder partners to understand when to use this, and probably more realtors than builders in this particular instance, because so many builders do owner occupied only. But there are many people that have the capital and the cash to invest in rental property, income producing property. But based on the way they do their tax returns and their cash flow on their tax returns, don't qualify for a conventional or loan, which is Fannie Mae or Freddie Mac. And Fannie Mae and Freddie Mac will allow for up to 10 finance properties. So that usually covers most people's real estate portfolio. But I have a borrower right now that's looking, and we're in a situation where he moved to Texas. Prior to the move, his income was higher. His wife had a certain level of income. And then this last year, he had, the way his taxes worked out, less net income. And his wife got a job here in Texas, but it's for less income. And so suddenly they have the cash. They're going to actually sell another rental property that they want to buy two more, but they can't qualify. So what debt service essentially does, and I'm going to hand this off to Jake to go a little more deeper dive, is we qualify the borrower just off what the rent is, the existing lease or estimated rent or rent survey based on an appraisal from that property. So tell us about it, Jake.
Hey, Todd, thanks for having me on. All that's right, yes. So this is our product, debt service coverage ratio for investment properties only. The reasons Todd mentioned, great reasons. Income issues on tax returns, maybe recent changes in life that have you coming up a little short from a debt to income ratio standpoint. Something that he mentioned is that Fannie Freddie caps the amount of finance properties at 10. On my product, I'll go up to 20. So the cap is far greater. And just the process of getting approved, that's a lot easier. So we're not looking at income documents. We're not looking at the borrower's income at all, actually. Our focus is solely on how does the subject property cash flow. We look at rents from the appraisal, we compare that to our payment, and we usually want that to cover our payment. The simplicity of using this product for property investors, let's say somebody that's a seasoned property investor like your guy and gal, and they own a number of properties. Well, getting the documentation to show how much they're paying for all those, adding them on your application you're taking, it can really get to be cumbersome. It can be a lot of work documenting the income from other rental properties, documenting the payment history from all those rental properties. On our product, it takes everything and simplifies it. I only want their primary residence listed on the application. I'm not going to focus on all other 20 or how many other properties they own. Our focus is solely on where are they living, and then does a property that they're purchasing, does it cash flow?
Yeah, so I'll go a little more granular on the documentation level just to give some flavor to that. So if you wanted to do a conventional loan, then, which is what people should do, the first 10 is, if you can qualify, they're a great product, but you do have to do the following. For every piece of real estate owned, we have to get a copy of the mortgage statement, a copy of the property taxes, and a copy of the homeowner's declaration page, and then a copy of, or confirmation, some kind of statement from the HOA if it's in an HOA, because that's our burden for the ability to repay. It's much higher on the conventional loan. The advantage of the interest rates are slightly lower, but for only a slightly higher interest rate, number one, you can buy in a rental property that cash flows, right? And number two, you can avoid all the extra work. It is a way simpler process. And one of the things for you as a professional out there talking to people that are buying homes, remember that they're buying a house really not for the cash flow. They're buying it for two reasons. They're buying it for the rate of the internal rate of return. Let's start with that. There's a calculation I do where I plug in and I can show based on the capital used and based on the closing costs and the rate, and then we do an estimated time frame for holding, which we usually use 5 years. What's the internal rate of return? And if we're getting 8, 10, 12, 15% return on that money, and that's pretty much guaranteed because it's a rental property, then that's way better than you're even to get from the stock market. Like last year, the S&P did 24%. That's an anomaly. That was basically post-COVID recovery, right? From like the 25% it went down the year before. It doesn't happen in this kind of thing. So it's internal rate of return and then also appreciation. We're looking for an appreciated asset and to build net worth off these. So it's super important to understand that this product really, for someone that has some capital and a good credit score, it's a great product. So any other comments about that, Jake?
No, I think you summarized it really well. It just simplifies the process of purchasing an investment property.
All right. So Jake, thanks so much. And for all of you, hope this was very informative. For any of you that have borrowers and potential buyers, send them over to me. Jake and I will help them out, and we hope you have a great day. Thanks, Jake.